The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
One of the reasons you're listening to us is probably because you have some interest in the stock market.
Indeed. Yep.
We do, right?
Yep.
Because we manage money. And if you're like us and many other professional managers of late, you've been saying, what on earth is going on? I found a cartoon accidentally, and it's I don't recognize the character. I recognize the characterization. I just don't remember the name of the individual in which cartoon he came from. But the comment was, I must be getting better, or has the stock market stopped going down? So when the stock market's going up, everybody thinks that they're really smart and good traders.
I'm really good at this. Yeah.
Until the market goes down. And right now, that must be challenging some of those people who have thought that they were good traders. I know from the past couple of years when we came out of the post-COVID rally.
Sure.
And you talk to somebody about an account, you need some management help, you need some risk profile. How do you handle a market? I don't need help. I'm doing really good.
This is great. Yeah.
I just haven't made a mistake. I started because the government gave me money, and I didn't have anything to do, and I didn't need to go shopping. So I've been trading stocks, and I've just been making money. I'm really smart. And it reminded me of the same phenomenon that went on with the tech bubble. As long as things were going up, everybody was a market guru until it quits going up. And that's kind of what it looks like over the last couple of days as far as the major indexes are concerned, which means the Magnificent Seven. I didn't prepare it. I should have brought up a heat map from the market the last couple of days. But if you look at it, if you don't know what a heat map is, it basically takes all the major stocks in the major 11 sectors, and it puts up the major stock in the sector, red or green, depending on whether it closed up or down. And when you look at that heat map lately, the upper left corner is all red. And it's Microsoft, it's Apple and Google, and I mean, it's all the big tech stuff, including Tesla. I mean, Tesla has had some up days of late, but it's also had some big down days. The Magnificent Seven has been driving the indexes higher for a while. And we've commented on it here, if you don't own the seven stocks, it's at points, it was down to 5. I mean, you weren't going anywhere.
You couldn't do anything.
Water.
Right. Yep.
And people are getting frustrated, particularly with their managers, and saying you're not keeping up with the market. And say, well, do you think 7 stocks is enough diversification for you? Well, maybe not quite that few.
It was fine as long as the market was going up. When the market's going down, it's like, why do you only own a handful of things? And all those are going down together. What are you doing? It's like, there you go. There's the other side of that sword.
So diversification has actually been a significant detriment to portfolio returns for a couple of years, actually.
Right.
Over the last couple of weeks, basically the title of today's session is Agonizing Market, and that's because the Magnificent Seven have rolled over, not enough to call this a correction, but certainly enough to cause both the NASDAQ and the S&P 500 to do some slipping in value. But at the same time, what we're seeing in the market is called rotation. People finally have agreed that NVIDIA might just be overpriced.
Believe it or not. Yeah. For a while, it didn't
And
look like it could be overpriced. Didn't matter how high it went, it was fine. And finally, it's like, well, maybe we overshot here a little bit, which is what markets tend to do. They overshoot on the upside and the downside. Doesn't matter which way, until cooler heads prevail and say, there's no way this should be this cheap, or there's no way this company should be valued this high. It's valued at perfection or more. And then the light finally comes on. Nothing runs at perfection, so maybe we overreached here a little bit.
so given on a particular day, the number will vary a little bit, but recently I saw the numbers were basically the top 10, the 10 largest stocks in the S&P 500 had contributed 50% of the entire index movement.
Hmm.
The other
Right,
490 were tagging along, and they were up as an index goes, but it took 490 of them to generate anything. Well, they weren't even close to the
right.
top 10. And as far as earnings concerned, the top 10 were generating 84% of the earnings in the S&P, which makes the forecast earnings look really good, even if the other 490 are losing ground, not making
Not
any
making.
progress at all.
Yep,
This we're in the middle of no, we're not really in the middle. We're in the very beginning of this quarter's earnings season. This is a
correct.
season where companies report on how well they did last quarter, and it's compared quarter to quarter and year over year. Now, if you're doing any of that comparison, I'd suggest you pay attention to year over year numbers. The quarterly numbers are kind of a forecast of the short term, but it's not really an indication of how well or maybe how healthy the company is and whether it's on track to continue to dominate its particular niche in its
Yep.
marketplace. We're going to find out this quarter just how well companies have been doing over the past year. And it's a critical quarter because it should be the first of 4 quarters where we have an uptick across the board. Now, that's good for the market overall, but we're in a seasonality period that traditionally is a weak market. Between now and let's say early October, the the market's historical perspective is not particularly strong. Yeah.
Pretty quiet, and there's significantly less trading, and there's less activity. There's less capital coming into the market, and that's really critical. And it's speaking of capital, it's really important to remember that those indexes, like the S&P 500, those are cap weighted indexes. So those companies at the top get the largest share of what moves that index around. That's why we can have this huge turmoil of turnover underneath what's going on, the huge companies at the top, because it takes so many other companies to make the index move, and so few of the companies at the top, if they're moving together, that'll override the other, like I said, on the other 490 companies. They just don't count as much. And it's not just the sheer number of them, it's how much they're weighted in the index. And that cap weighted index, you have to be at the big end to really make things happen. And we're really top heavy right now in the S&P 500.
Well, yeah, because there's the replication of the Magnificent Seven stocks over there, which is
Yep.
why recently the Dow is going up because it is not technology oriented. So the things that are affecting technology, money's been rotating over into the Dow. You get more healthcare and you get your energy exposure over there, even though energy exposure is quite light, should be picking up some industrials over in that area. But you mentioned the capital inflow. One of the things that is in the press and has been for several months at least is that there's concern about whether or not the consumer is running out of money to keep the
Correct.
economy rolling. More
Yep.
importantly, have they run out of discretionary money to put it in the market? We still need more money coming into the market to push prices higher. If we don't have buyers, prices won't rise. And we've had a significant change in the last week where we've had money coming in to the small cap area. We haven't seen a lot of rotation into emerging markets or international. Uh, there's value there, but there's been value in the emerging markets off and on, well, significantly since 2011.
Right. Right.
With a few rallies along the way, the 2011 high still stands, I believe, on emerging markets. So diversifying, here's another area where diversification isn't always a benefit. Yes, you own emerging markets. It is foreign exposure, which is slightly different than U.S. exposure, but it's a losing game. And our issue is, why do you hang on to losing positions, much less asset classes, for long periods of time? Wait until there's evidence that the change has arrived and then get in. You typically get in at a lower value and not spending a lot of time recovering from the losses that you took because you were blinded by perhaps a weak theory.
That's true, and that's why what we do is so significantly different from the pie chart managers that have diversification by asset class built on historical return models, which say we don't care if emerging markets has been a losing proposition for well over a decade. We think you should own it anyway, because at some point in the future, it's going to be fine. We agree with that point. Some point in the future, it's going to be fine. But because we're trend followers, we're saying if it's out of favor and it's losing money, let's just not own it now. And then when it's back in favor, let's go back in. And we're not talking about super short-term day trading here. We're not in and out of asset classes, 4 times a month. That's not the way this works. That's not the way trends work that we're following. They're bigger moves than that. And they take longer to form, and then they're going to be true for a bit. We never know how long. There's no guarantee how long a trend is going to stay, both because of just the economics of how the market works, but external forces, things happen, natural disasters happen, wars start. You never know what's going to push the market around, and you have to be ready to adapt to what's going on currently, and that can keep you in a much better position to stay on the good side of trade. You have a much higher probability of being profitable and being in a profitable area of the market just by saying, you know what, this part of the market's losing money. Let's just not be there. Let's don't try to find a winner there. Let's just not be there right now. And that can really be the best move most of the time.
Well, I'm thinking of the review we do of charts on a weekly basis relative to the S&P. Is this sector, this particular industry, is it doing well, better than, worse than the S&P 500 as an index?
Yep.
So as we go through that for the last several months, most every industry group that we looked at compared to the S&P was doing better. And it just was evidence that the Mag 7 was the only driver in town. And this last week, we had some resurrection. For instance, consumer staples is one that actually hasn't turned around. You'd think with the indexes falling, people were getting fearful. But consumer staples, the toothpaste and toilet paper and the bread and the eggs and the milk that people need, you would think that people would be piling into that if they were full of fear. And it isn't. It continues to drop lower than the S&P. And then you look at consumer discretionary, and if people were running out of money, why would higher price things still do well, or vacation travel, hotels? Those are discretionary items. Automobiles, well, though auto sales are starting to turn down, the prices are getting high enough. People are saying, I just don't think I can afford that. I'm going to keep my old car.
Not now, yeah.
But one of the other defensive areas is healthcare. If people are looking for an area that is going to be in stocks in a falling market, healthcare is an area that the demand doesn't go away. And so insurance companies and Medicare and Medicaid, they keep paying the bills. That's an area that attracts money. And yet it has underperformed the market all year long until just the last couple of weeks. Now, I say that, but now there's always a but. And that is that while there's been a bit of a recovery, it really hasn't broken above what we would call in technical terms significant resistance. So the rally in healthcare, and I look at XLV, which is the Spider Healthcare Exchange Traded Fund, XLV, Victor, has come up and then backed off again. So whether or not it's able to maintain some momentum and actually start moving up, if it doesn't, that means that there's really not a lot of fear. What there is rotation, money moving out of the major brand names into smaller companies, small and mid-cap companies that are lesser known, but in the indexes that are available for them, they're attractively priced and they have had a parabolic move over the last week.
Correct.
Which begs the question, how long will parabolic moves persist? They always have an end. And the question is, will this turn into a more normal market ascent, or will it quickly reverse like we see with the meme stocks, AMC and GameStop? There are a couple others that the memes play games with on the stock market. Basically, instead of going to Vegas to gamble, they do it on the stock exchange.
It's about it. Yeah, it's about it.
But this rotation is going on. We've been hoping that this rotation would come along. We just never expected it to be as rapid as it has been in the last week. This is really a radical shift of money. But
really
the major drawdown in prices is created by a lack of buyers. And when buyers go away, prices drop. So if nobody's buying NVIDIA or Apple or Microsoft or Amazon or Google, then prices have to adjust. And as we said earlier, it may simply be that the time has come to recognize speculation was driving it over AI, and the prospects of real economic cash generating activity from AI is a bit further off than people were estimating as early as this year. It may be something like the continual hopes for Elon Musk to get his autopilot taxi program approved and operating on the road. It seems like every time it gets close, the origination date is pushed off another quarter or 6 months or a year. And that's where AI profitability looks like it is as far as product and profit generation is concerned. And you have anything else to add here today, Perry?
No, we're good. It's just that's the nature of rotation. It's not always reflected in the value of an index, and it's important to, as we always say, look under the hood and see what's going on, because it can be very different in the even just the slightly broader market than it can at the very top of a cap weighted index.
Well, thanks for tuning in. You want to talk to us or have us take a look at your portfolio and give you our perspective on it and how we view your particular holdings, give us a call or send us an email. It's a free service to let you have some individual time with us. Stay tuned and subscribe for our next podcast.